Welcome to Markets Plus, where leading experts from across BMO discuss factors shaping the markets, economy, industry sectors, and much more. Visit bmocm.com/Markets Plus for more episodes. The views expressed here are those of the participants and not those of BMO Capital Markets, its affiliates, or subsidiaries.
Today, we have a special episode from BMO's In Tune podcast that aired on July 17th, 2024. In Tune features equity research analysts from BMO Capital Markets and explores key emerging themes, trends, and issues which are important to our institutional clients globally. In this episode, Camilla Sutton, Managing Director of Canadian and UK Research in our BMO Equity Research Group, and Doug Morrow, BMO ESG Strategist, sat down to discuss how the AI and data center build-out is contributing to a new era of electricity demand.
One of the most important investment themes right now is the AI and data center build-out. I'm thrilled to have our ESG analyst, Doug Morrow, join us today to walk us through how to think about this from an ESG investing lens. Doug, let's get this kicked off. In late June, your team published a note titled, "The AI and Data Center Build-Out, Sustainability Impacts, Second-Order Beneficiaries." Walk us through it. What are the key takeaways for investors?
Thanks, Camilla. I think the first key takeaway for investors is that AI is really going to push us into a new era of electricity demand. So in the US right now, electricity demand over the last 10 years or so, maybe 12 years, has actually been relatively flat. So even though GDP went up by over 60% over the last 12 years, the amount of electricity used in the economy was relatively stable. This is because of efficiency. Basically, as in other economies, the US economy has become much better at squeezing more value out of each electron due to more efficient manufacturing processes, industrial processes, consumer products, etc. But what's going on now is that AI is coalescing with other trends, including the electrification of transport, the electrification of heating, reshoring, and even climate change to just fundamentally change how much electricity we use. So generative AI models such as ChatGPT are really fun to use. You know, my kids like to use them to ask it questions, but they are 10 times more energy intensive than a Google search. Second, there's going to be a supply response to this trend, and it's not going to be green, or at least not fully green. And what I mean by that is if you look again at the US, for example, about 77% of all new generation capacity brought online last year was renewable. So basically a mixture of wind, solar, and storage. And that's because the US, like most countries, is trying to green its grid. So yeah, to kind of nail it home, 8 out of every 10 megawatts added to the grid last year in the US was zero carbon. But I don't think we're going to see that ratio again for a while. The demand numbers coming from these data centers are just so big that they're going to require more natural gas plants to come online. And we're also going to see existing coal and nuclear assets stretched out as much as possible. So the demand numbers coming from the data centers are just so big that they're going to require more natural gas to come online and existing coal and nuclear assets to be stretched out as much as possible. I mean, we're definitely going to continue to see more renewables come online too, but it's not going to be 77% of the total. Our best guess is something in the neighborhood of 50% gas and 50% renewables. And then the final takeaway for investors here is just to point out that data centers power these generative AI models use large amounts of water to cool their IT equipment. So the typical air-cooled hyperscale data center uses 2.1 million liters of water per day. And most of that has to be potable, i.e. fresh water. And that means that data centers are competing with farmers, local communities, and other industrial users for a resource that is showing more and more signs of strain, especially in places like California, the Colorado River Basin, and parts of the Midwest. So Phoenix is actually the world's second largest data market by commissioned power. And Phoenix is a city that is under growing water strain. So approximately 20% of data centers in the US right now are based in watersheds that face moderate to high stress. And we do not believe that the water and grid congestion impacts of data centers are widely appreciated by local communities, despite some of the protests that we've seen. So yeah, I think this means there is a risk of community opposition to data centers that is probably being underestimated. And we think investors should be engaging with the management teams at hyperscalers such as Google, Microsoft, Meta Platforms, and Amazon, as well as the co-location companies such as Equinix and Digital Realty, to see how they're thinking about mitigating this risk.
Some of these stats are mind-boggling, Doug, and they really do support your view that the era of flat electricity demand is completely over. Well, let's shift gears a little bit, kind of where you left off in the last answer. What are the large tech companies like the Microsoft, Amazons, Metas, Alphabet thinking and doing regarding a sustainable approach to AI and data centers?
Yeah, generally they're doing a really good job. They are highly incentivized to green these data centers as much as possible. Not only does this drive efficiency and help them lower costs, but it also helps counteract that community opposition angle, at least to a certain extent that we talked about. So yeah, like I said, generally speaking, we think these companies do an excellent job on sustainability, but what we're finding is that they face a trade-off right now between growing their AI business and hitting their sustainability targets, at least over the short run. So where it really hits home for them is on Scope 3 emissions. So Scope 3, this is another one of our takeaways from the note, is really going to be the next frontier in greening data centers. So let's look at Microsoft, for example. Microsoft, in our opinion, is a great climate company. They have slashed Scope 1 and 2. They have a strong commercial upside to our warming planet. They are part of the BMO Climate Opportunity Screen, but their Scope 3 emissions are 76% off target. And this is mostly due to the embodied carbon in their data centers and IT equipment. It's a similar story at Meta. We would say Google's probably doing the best on Scope 3, but they do take a bit of a different approach compared to Microsoft and Meta. Amazon trails the other hyperscalers generally on sustainability. One of the things we highlight in our note is they're the only ones amongst that peer group that do not publicly report their water consumption, and they actually stopped reporting their electricity use back in FY22. So those are some things that we flagged in our note.
That's amazing, Doug. Appreciate it. You argue also that several sectors are going to benefit as the green data center theme takes hold. What are these sectors, and specifically which companies did you identify with that revenue upside?
The themes we like here are grid stabilization, clean power production, alternative cooling, low carbon building materials, and data center engineering. We see these themes as second derivative plays on the broader AI and data center thematic. On grid stabilization, we like Fluence Energy. This is an energy storage provider that is exploring behind-the-meter solutions for data centers. On clean power, we highlight companies like Constellation Energy and Vistra, as they are well-positioned to benefit as U.S. electricity consumption increases. And they also have nuclear in their generation mix, which opens up the possibility of doing nuclear PPAs with some of the hyperscalers, which is a new trend, and we think that could play out in the next little bit. Companies offering alternative cooling would include names like Chemours and Ecolab. And for engineering, we highlight Stantec and WSP. Low carbon building materials, this is a bit more challenging. It's still an emerging field. But for low carbon aluminum, IT equipment, and green steel, we highlight names like Alcoa, Nucor, and Palo Alto Networks as solution providers. And all of these things are going to be essential for the large hyperscalers to tackle the Scope 3 emissions in their data centers.
By the way, Doug, your table on page 3 of the report, it's an incredible summary of just what you've said, all of these names with a lot of details. So it was really useful as a reader. Why don't we dig in a bit more to the alternative cooling theme? Can you tell us what Chemours is doing versus companies like Stantec and WSP?
Yeah, so right now, most data centers use air cooling to dissipate the heat from their IT equipment, which, as you can imagine, running 24/7, very powerful machines, they throw off a lot of heat. So this system basically involves traditional air conditioning. They also sometimes use a heat exchanger that creates chilled water that runs through pipes that's used to dissipate the heat. Now, as mentioned already, one challenge with this type of technology is it uses a lot of water. But another, perhaps even more important drawback over the short term, is it's starting to bump up against technological limits. it's starting to prove incapable of simply dissipating the amount of heat that's being produced by these higher performance chips that are used in AI applications. So as a result, over time, we think we're going to see more data centers shift to these alternative liquid cooling technologies, especially hyperscale size AI dedicated data centers. Now, some of these new technologies offer significant sustainability benefits. For example, if you think about two-stage immersion cooling, so this is where IT equipment is actually fully immersed in a tank of dielectric fluid. This can yield a 100% reduction in water consumption and a 95% reduction in energy consumption that's tied to cooling. This is all compared to air cooling. So really some significant sustainability advantages as well as more powerful and dense cooling potential. The company from our coverage with the most torque to this theme, the two-phase immersion, is Chemours. Now, you mentioned Stantec and WSP. These are really strong data center engineering names, and they may be involved in data center layout and design, but it's really Chemours that has the major upside exposure to this two-phase immersion cooling.
It's amazing how all that technology is changing so quickly. Well, why don't we close out here with a big blue sky question? With everything that you've learned in researching for this note, do you think AI will have a net positive or a net negative for the environment overall?
Well, that's really the top of mind question for many people in the industry. It's simply difficult to say at this point, but as a natural optimist, I'm inclined to say net positive. I think AI is showing promise in improving sustainability outcomes in many fields. If we think about things like traffic and route optimization, precision agriculture, resource forecasting, etc. There's a certain irony, though, in that AI is also being used to optimize power grids when the massive power requirements of AI models in the first place are probably contributing to grid instability. So I think there's also a certain irony in how we're using AI to solve problems that are in part being driven by AI. Look, I think over the short run, it's really crucial that investors understand the electricity and water appetites of generative AI models, not only from an environmental standpoint, but also because we think mitigating these impacts over time is going to provide really compelling investment opportunities in and of themselves.
Doug, I love where you've taken us on this podcast and within your note. It's been a really interesting exploration deep dive into where we are with data centers and the AI build out from a sustainability lens. That was Doug Morrow, Director of ESG at BMO Capital Markets.
Thanks for listening. You can follow this podcast on Apple Podcasts, Spotify, or your favorite podcast app. For more episodes, visit bmocm.com/marketsplus.
For BMO disclosures, please visit bmocm.com/podcast/disclaimer.